Ladies and gentlemen, the stock market fell apart today. This was because of a bad bond auction. Demand for treasuries basically is drying up, and this bond auction today sent yields skyrocketing across the long end of the curve. That is why you've seen that violent sell-off, towards the later half of the trading day. Okay. And it just continued to go lower. Now, let's be honest. We're going to talk about this. I'm going to call it the crisis in the bond market. Okay. Because that's what it is. There's a couple things to note. Okay. Moody's downgrade kind of started this worry in the bond market, but it's not new. It's something we've known about for a long time. What's actually fueling this at this point is progress on the big, beautiful bill. Okay. As some people in the White House have said today, if GDP gets to 3%, the tax cuts pay for themselves. But if not, then you're getting into an even worse fiscal position. Now, something has to break. If this is really a crisis in the bond market, as we get closer to 5% on that 10-year treasury yield, you're going to need to see something change. I don't know if that is a complete just cancel the trade war. I don't know if that is the Fed cutting rates. I don't know if it is changes to the tax bill, but something would have to change, right? Because the worse the problem gets, the harder it is to come out of. Even think about the banks, right? For all the banks that own these bonds, I mean, look at TLT. You're at the danger levels that you were at in 2023 with like the bank runs and all of that, okay? All the losses the banks are going to have to start to actually realize here gets pretty nasty under this level. This is looking at a monthly chart. Normally, like when things get bad, like here, is kind of the end of it. Okay? You could draw a horizontal trend line here. Like this is a pretty critical level. The last time we went below this, again, was banking blow-ups and fears of a larger, issue in the banking sector. Okay, that's one area that would be hurt. But anyone trying to finance anything, business loan, auto loan, home loan, basically, it can't happen, right? So with the bond market breaking, it's a little different than the stock market. People care about stocks, but are they nearly as important versus the bond market? No, right? From an actual economic perspective, from a lending perspective, from a government, financing itself. The bond market is what matters, not the stock market. We even seen when Trump pivoted and did the pause on all tariffs besides China, it was really because the bond market started to break. And again, you're there, right? So while nothing has dramatically changed besides this bill and kind of more details on what this quote unquote big, beautiful bill could look like, it doesn't change the fact that the bond market is revolting this. And pretty soon you're going to have to see some kind of intervention. Now, I've had some people ask what again could bring down treasury yields. Okay. Couple things. Again, pausing the trade war entirely would, because inflation would presumably not be a problem. The Fed would be able to cut rates. Changes to the tax bill and or better economic growth, right? Tariffs are negative on growth, negative on inflation from the market's perspective, even though I don't agree with that assessment. Canceling the trade war would possibly be something that would have to be done. Okay. Or even the Fed could step in and start buying bonds if things got, worse from here. And today's bond auction was terrible. I mean, it sucked. Take a listen to this clip from CNBC talking about this bond auction today, because it was the catalyst that sent markets literally free falling. Right here.
For lunch and take a look at yields. The yield on the 20-year bond is higher, now at about a couple-year high, 5.11 after the 1 p.m. auction that pushed yields up on the long end across the board, really. Let's turn to Rick Santelli for more with the Bond Report, joining us out of Chicago. Rick, stocks were certainly not happy about this one.
No, and I can understand that. Before we get to my charts, I've been getting tweets all morning and afternoon. Is this a Liz Truss moment in the markets? It feels like it. And my answer to that is really, really easy. The 10-year, where do you think the 10-year closed at the end of last year, Kelly? I'll tell you, 457. Where is it now? 458. I would think a Liz Truss moment be worth more than 1 basis point personally. Does that mean it's not important? Of course not. Does that mean I'm not tickled that we're finally paying attention to debt? Yes, hooray. Let's start at the beginning now. Let's look at a chart of 20-year bonds and 30-year bonds U.S. because right now, both of them are above levels from January of this year that we were comping to, and we zoomed all the way back to around November 1st of 2023. So that level for the 30-year would be just a whisker under 5%. That level for the 20-year is around 506. And as you pointed out, we're well above that. Now, many are paying extra attention to the 30-year bond, and that's all great. But, you know, back when I started trading bonds in the early 80s, the 30-year was the king of the curve. That's not true anymore. It's the 10s. But the 30-year is now gaining distance. Look at the knob spread. This is the 30-year yield minus the 10-year yield. And you could see that we are virtually at the highest levels going back to 2021. That's important because I expect term premium and these spreads between the maturities to keep widening. But don't lose perspective on which maturities are the most important at this point in time. Everybody was looking at the close today with the 30-year Japanese government bond. It closed at 313. They first had an issuance of this bond in September of 1999, which that chart goes back to. You see what it looks like? Of course, we have blown through all the yields were higher than ever before. Now, let's keep that date, SEP of 1999, and look at the dollar yen based on the interest rate differential for foreign exchange. And notice, we're at 143 and change. Notice how 140's been a bottom for years. And notice how historically it's a very lofty level for the dollar still. And that's important to keep in mind. Take a macro view when everybody's hair is on fire. Kelly, back to you.
Rick trying to calm everybody down. Just, I'll get used to it at some point. Rick, thank you very much.
So yeah, some people are calling this or saying this could be the Liz Truss moment, which, if you guys remember, was it early 2024, 2023, when UK auctions on their bonds, like demand completely dried up, pensions were like going bust, and yields skyrocketed momentarily. Liz Truss like stepped down, and that there was a lot of fears of that situation getting even worse, okay? Some people are saying this is that moment again, where all of a sudden this bill mixed with tariffs, mixed with, higher inflation expectations, lower growth expectations, could be another Liz Truss moment. I don't think so, personally, although there is a rising risk of that as Treasury yields continue to rise. I think there would be something done about it, right? Somebody would have to step in. Probably the Fed would have to go out and buy bonds because, again, even consider that where inflation is, the higher treasuries go, the higher the yields go, the more restriction is put on the economy. So even if the Fed wanted to make up an excuse for bailing out the bond market, they could say, hey, we want to be moderately restrictive. We don't want to be very restrictive. Okay, I think that's something the Fed is probably talking about now, as we speak. And I wouldn't be surprised if we get a little bit of a Fed bailout, especially if 10-year Treasury yields start to go closer to 5%, because then you risk the dual mandate getting blown up, at least on the employment side, from a lack of lending. That would be the thesis on why the Fed would ultimately step in. I think that's most likely. I don't think Trump would be quick to cancel the trade war. I think the Fed would probably be first to step in. Now, let me read this to you guys. It's from an article from CNBC. It says the Republican spending bill is sending yields soaring and creating a major market headache. Again, it's not just the U.S., it's global yields. So there's only a handful of countries or so that have a better rating than the US, right? That have that AAA rating. Okay. So what does a downgrade mean for the UK? What does a downgrade mean for Italy? What does a downgrade mean for Japan, right? As you've seen in that clip, it's worse for them than it is for us, right? If you're evaluating risk, it would be like, if Apple went bankrupt or was having a problem, okay? Don't you think like Samsung would also be like grouped in that category? Like, oh crap, if Apple's having a problem, then Samsung's really having a problem, right? That's important, and that's why global yields are rising. But it says, with the deficit heading to 6.5 to 7% of GDP, that is, quote, inconsistent with debt to GDP stability over the long run, said Matthew Suzzetti, chief U.S. economist at Deutsche Bank, said in a client note. Absent a clear commitment towards putting deficits on a downward path, investor concerns about U.S. fiscal dynamics are largely or likely to persist. How much the budget will get stretched is dependent on the final package that gets through Congress, but markets are betting that making the 2017 tax cuts permanent, as well as eliminating taxes on tips and overtime with only partial revenue offsets, will aggravate the fiscal problems. Quote, if the bill fails, the financial markets won't be happy. But if it passes, well, that might be just as problematic, wrote Ed Yardini, head of Yardini Research. Why? Because budget deficits matter. That's especially so when they lead to higher interest rates, higher bond yields, and potentially higher inflation. We suspect the bond vigilantes already anticipate this. So bond vigilantes, you guys are probably going to start hearing a lot more about this, especially if yields continue to go higher. But it's basically investors that put pressure on the bond market to enact change, right? So right now, yields are drying up for bonds. So banks are buying less bonds, citizens are buying less bonds, investors are buying less bonds, other governments are buying less bonds. The vigilantes, right, are basically saying, you can't do this. We don't want you to do this. Now, they're not senators. They're not in the House of Representatives. They're sure as hell not the president. So the way that they can kind of manipulate things is by yields, right? It's kind of like GME, right? Back in the day when GameStop went crazy because everyone got together with a certain narrative and it had a huge effect. That's essentially what a bond vigilante is. You know, good thing, bad thing, which way they want to push yields, who knows? Doesn't matter. It changes. So the bond vigilantes are trying to enact some change. That's essentially, long story short, what bond vigilantes are. So again, am I super worried about this at this point? No. Given the rally we've had and what bond yields have done, I actually think it's pretty impressive that stocks are still near all-time highs, given what's happening with yields. But if yields continue to climb closer to 5%, as I talked about previously, above 4.5%, you start putting pressure on markets from a valuation perspective, because you can get 4.5%, for 10 years risk-free. That seems like that's not bad. Like if you have $1 million and you're looking to retire, you can get $45,000 a year just because. That is not terrible at all. You're going to get 45% over the course of 10 years. Like that sounds pretty good. You got $2 million, put them into 10-year treasuries, lock in a 10% yield. You get paid $80,000 a year. And in 10 years, you'll still get your $2 million back. That's the pressure here. Okay, and that's really why bond yields matter for stocks. It looks like the 10-year Treasury yield closed at 4.597%, so almost 4.6%. I believe under 4.50, 4.5%, you're fine. But above 4.5%, the algorithms are going to trigger some pain for stocks. Now, you get closer to 5%, that's when we're really talking about the Fed doing a bailout of the bond market. Again, the Fed would label this like we're getting too restrictive, okay? The Fed doesn't want to be 5% on the 10-year Treasury restrictive at this point, so it's threatening their dual mandate. That's what roughly the Fed would say if they had to step in and start buying bonds, okay? Other things could obviously happen, right? But that would be most likely, in my opinion. They could obviously take out the no tax on tips, no tax on overtime. I actually think that's probably a good thing, since people spend all of their money. Like, that would really invigorate the economy, give people more money to spend, and overall be a positive. But that could also get taken out of the bill, which I don't think a lot of people would like, but I think the bond market would like that. So are you in full-blown crisis mode? No. Are you kind of getting to a worrying level following this bond auction? Sure. I mean, if other bond auctions that follow this continue to show bad demand, you could be at a 5-year, 10-year Treasury yield in the not so distant future, okay? Tomorrow morning, you're going to have some data coming out. Chicago Fed National Activity Index, initial jobless claims, S&P Global Composite PMI, Manufacturing PMI, and Services PMI, as well as existing home sales, Kansas Fed Composite Index, and Manufacturing Index. You will get a 4-week bond auction, an 8-week bond auction, and a 10-year TIPS bond auction. That is Treasury Inflation Protected Security. So kind of more or less a measure of inflation expectations over the next 10 years. Okay. So definitely going to be important to watch, but no big bond auctions tomorrow to speak of. On Friday, you don't have any bond auctions as well. So maybe we get a cool down of the rise in yields, but this is kind of what I've been saying now for a while on the channel. You kind of need to see a little bit of a speed bump or a little bit of a reset here anyways. I'm not super shocked, but I do think overall, before we had a full meltdown in the bond market, which I think happens closer to about 5% on the 10-year Treasury, you're going to have the Fed step in. You're going to have Trump step in and, change things as far as the trade war or as far as the quote-unquote big, beautiful bill to prevent that, because literally nobody wants that. There is no positive from a bond market, freak out panic. You can't let it happen, essentially. So while markets could move lower in the near term, again, there is the Fed put, the Trump put, all of that is fully intact when it comes to the bond market. Not the stock market. They could give a crap less about the stock market, but the bond market, different story. So let me know your thoughts again on all of this down below in the comment section. Have a great rest of your day, and I will see you in the next one.